they should probably be doing that buyback right now. I don't know why they'd wait. Like if you're running the company and thinking about the best use of capital, yeah, we understand they're making these one-off investments into, a lot of projects that they think are benefiting long term, but the free cash flow here has just absolutely exploded. I can't think of a better thing for them to do than some float shrink while the market may be bored with the story or whatever.
Well, who's your incremental buyer, though, Josh? I'm serious about this. You have 95% of the sell side that have buys on this, and you have everybody. It's 8.5% of the S&P 500 waiting. So obviously, there's a lot of owners. Who is your? I mean, I don't think at 23 times, or okay, maybe say 18 times.
Didn't they say that about Apple at 200 and it went to 300?
But I don't think at 18 times. I don't think it's for value buyers are going to be jumping in at 18 times. I mean, I think it's going to take a cheaper multiple for the value players. I'm not disagreeing at all with the growth. The growth is amazing at this company. It was a phenomenal quarter. I think the guidance for 27, people wanted more color. I think that's one of the reasons why you've had this subdued reaction.
But which they did again, showing us outsized growth that nobody else can do in 75 to 80% gross margins. It's just become such a common story that it's hard to really impress us anymore.
Does the buyback help with that problem?
I don't think so. I don't think the dividend increase even makes enough of a difference, even though it was 25 times what it was before. Because you're not buying this stock because you care about the current income. You're not buying this stock because you want them to financially engineer their way into a great share price appreciation like an Apple, for example. You're buying this stock because it is the innovation engine. You're buying this stock because they're the leader.
If the stock is selling 18 times earnings, they just upped their authorized buyback from $39 billion, which was what was left on the original, to $80 billion.
Palantir, one of the most compelling enterprise AI stories on Wall Street, saying its software helps companies solve real-world business problems. Wolf highlighted Palantir's rapid growth, including revenue up 85% year over year and a strong expansion in its deal backlog. But the firm stopped short of a bullish rating, assigning it instead peer perform with no price target. The rationale, the stock already trades at a premium to other software names. Keep in mind, it's been a tough year for Palantir, with the stock down more than 20% year to date. All right, time now for the tug of war on Palantir. For that, let's welcome back in our co-hosts, Tom White and Kevin Hinks. It is bull versus bear time. So before we jump into the example trades, we've got to get each of your thoughts on this name. Kevin, I'll start with you. Your take on Palantir.
Palantir is such a leader in AI. From what they do, they are a group of one. They're one of one. They don't have a lot of competition. However, they are caught up in this software sell-off that is harsh and taking significant percentages out of these companies. And let's face it, Palantir is got a massive valuation. Their turning point for them was when they were able to take that government, a product mainly aimed for the government and put it to small and medium businesses. That's when the stock went crazy. That's still out there. They're still doing the same things, but the valuation that they're taking out of this company is pretty significant. On the chart, you can see that 127 level is really important for Palantir. But all things considered, this is a leader. This is a company that takes the data and helps with decision making. And so it's just a matter of time, I think, personally, that this company firms up. But right now they are under pressure because of this software group, and I don't know where the bottom is. I don't know when the pressure on software stops, but they have taken some serious percentage in valuation out of this company, Diane.
Tom, your take.
Yeah, well, you look at their last earnings, 85% growth rate on revenue. That tells the story right there. They're gathering more, clients for their AIP, their platform, and they continue to grow that growth rate too. That's a hard combination to do. If you take a look at it, their AIP platform, businesses use it, the governments use it to make AI usable and monetizable for their businesses and for the government on the other side to make them safer at this point. So as Kevin mentioned, they are one of one because they don't have a pure competitor in this space. That's maybe why their growth rate is so big at this point. But at the same time, their valuation's a lot higher than anybody in enterprise software at this point. I believe the forward PE, the multiple is like 90 times right now, and I think the industry average around 20 times. So that's been the thorn in the side of this stock over the last 6 months or so since hitting those all-time highs, and why it's pulled back over 30% from those levels is valuations moving forward. Are they sustainable? It did get pulled down with the SaaS apocalypse trade. That kind of hurt the shares also. But yeah, to fall 3% after an upgrade, I know the upgrade was only to peer perform, which is basically neutral, but the analysts kind of pounded the table on, hey, we're putting it at neutral. We were wrong. They were at underperform before, but they don't feel like it's a neutral type of stock, that they're still maybe bullish on it, even though they just went to peer perform.
All right, let's get into the example trades. Kevin, let's start out with yours. What's your approach today?
So I'm going to do something a little different. And it's a complex trade, and it's basically using a cash.
Nvidia just got another massive bullish signal. If there was any doubt that the AI infrastructure build out is slowing down, then Micron earning call just answered that question. And the answer was very clear. Demand isn't slowing. In fact, according to Micron management, the AI memory market remains supply constant well beyond the 2027. That statement alone has a huge implication, not just Micron, but for Nvidia and the entire AI ecosystem. The compute shortage is still real. For the past years, many investors have worried that the AI spending would eventually slow down. Some believed hyperscalers would reduce the capital expenditure. Others expected demand to normalize after the first wave of AI investment. But that's simply not what companies are telling us. Alphabet has reportedly said it's remained compute constant. Micron continue expanding AI infrastructure, and Meta keep increasing capital spending. Amazon continue building new AI data centers, and Oracle is accelerating cloud expansion. And now Micron has confirmed that memory demand remains far ahead of the available supply. These aren't the opinion. These are the statements directly from the companies building AI infrastructure. Memory is becoming one of the most valuable part of the AI. Several years ago, GPUs received almost all the attentions. Today, that's not longer enough. Every new AI models require more memory, and every reasoning models require larger memory capacity, and every inference workload need a faster data movement. Without a high bandwidth memory, even the fastest GPUs become bottlenecked. That's why HBM has become one of the most valuable components inside every AI servers. And that's exactly why Micron pricing power has increased so dramatically. Nvidia roadmap keep getting stronger. Another important takeaway is that Micron confirmed HBM4 production is already ramping for its lead customer. That lead customer is Nvidia. HBM4 power Nvidia Vera Rubin platform. Micron also confirmed that HBM4E development remains on schedule for Rubin Ultra. This matters because Nvidia product roadmap now stretches several years into the future. Blackwell Ultra, Rubin Ultra, and eventually Phenomenon. Each generation increases compute performance. Each generation requires significantly more memory. That's creates a powerful growth angle for both Nvidia and the Micron. Long-term contracts change everything. Historically, investors viewed memory companies as unpredictable. Strong years were usually followed by the sharp decline. But today market look very different. Micron has now secured a multiple 5-year strategic agreement with customers. These are in the quarterly purchase order. These are the long-term commitment that provides visibility into the future revenue while reducing the uncertainty that traditionally surrounded the memory business. It is one of the biggest structural change we've seen in this industry. Why investors should pay attention? One point that management repeatedly several times stood out to me. The company expects demand to extremely strong because AI adoption is still in early stages. Think about where AI is today. Most businesses are only beginning to deploy AI assistant. Agentic AI is still in infancy, and physical AI hasn't reached the mass adoption. Humanoid robots are only starting commercial deployment, and industrial automation powered by AI is still developing. If demand already exceeds the supply today, then imagine what's happened as these technologies become mainstream.